Yeah, no, I still think this economy, the US economy in particular, we're talking US here, the US economy is heading towards a recession. And I think, the signs are just getting clearer. And I was talking to someone just chatting earlier, and the way I would put it is that I've always said there's a difference between the headlines, like the unemployment number, and what's happening under the hood. There's a difference between consumer spending and what's happening under the hood, or the bonnet in England. And I just think that we're starting to see those headline numbers get a little bit worse. Like unemployment has ticked up, new jobs is a little worse, new unemployment claims is a little up. Nothing dramatic, but just a little up. But if you start to look under the hood of these things, I think things are a lot more serious, a lot more negative than the headlines suggest. And unemployment, just quickly, unemployment, I mean, we can talk about government, most of the new jobs are government jobs or government-related jobs, a lot of people working 2 jobs, a lot of part-time jobs. The reality is that despite the payroll numbers going up for the last 2 years in a straight line and looking very, very strong, the reality is that the US economy has lost last year over 1 million full-time private sector jobs. And it's full-time private sector jobs that are driving the economy. You can have all the government jobs you want. That doesn't make a strong economy. I think we should be very nervous right now, frankly, because, a bit like Hemingway's bankruptcy, slowly at first and then suddenly. I think we should be getting nervous now. And again, another part of the economy to look at would be consumer spending. And I know we talked about this last time because it's been true for 6 months, but it's now just getting worse. Consumer spending has been going up. So the bulls are saying, well, the consumer's strong, the consumer's still spending. Now, first of all, consumer growth in consumer spending was less than the rate of inflation. So that in itself is a bad sign. It means the economy, the consumer is not continuing to buy as many things as he was before, or changing the quality, going from, name brands to store brands, etc. But now we're starting to see the consumer spending slow, and at the same time, credit card debt zooming. And buy now, pay later, zooming. So people are not buying out of income. And so again, consumer spending can continue to move up for a little bit longer. But if the consumer is not buying out of income, did I say savings earlier? I meant income.
Yeah.
If the consumer is not buying out of income, it's not sustainable. It's not a good condition to be in. Right, absolutely. And with credit card, most of this is credit card debt, of course. Yeah. You don't go to the bank and get a loan to go to Disney. Credit card debt is, 24% average now? But for a lot of particularly lower credits, it's 30%. Well, if you borrow, I don't know what it costs to take a family of 4 to Disney, but it's going to be $5,000 for that trip, right? You borrow $5,000, you put $5,000 on a credit card, and you can't pay it off next month, obviously, because if you could pay it off next month, you wouldn't have borrowed it in the first place. When you're paying 30% interest compounded daily, that puts you in a really bad spot, particularly since COVID, of course. But we've had several years now where the government is just handing out money, and the government is also writing off debt. So you had student loan debt, don't worry about it, that's now gone. Not for everybody, but no. They wanted to do it for everybody, but the Supreme Court shut them down, as you know. But different sectors now have their student. So I think a lot of people, their experience of the last, 5 years is, the government will send us some money and debts at some point will be written off. Don't worry about it.
Yeah, that behavior is mind-blowing to me. Like, that you even act, like, irresponsible is the word I was looking for.
It's right? Very irresponsible. Yeah, like you. I mean, my dad, well, he's a different generation, of course, but he didn't have a credit card. He refused to get a credit card. Other than house, no debt ever. Car, we didn't have a car till I was 13. He said, I'm not buying a car till I can afford it. Yeah. I mean,
yeah,
what a concept, right?
Yeah, right? Mind-blowing, right? No, especially in the pay now, pay later, when you buy now, pay later.
That is so dangerous because there's no credit checks or anything. You just say, I want to pay what I don't even know what it is. Is it 10% down? I don't know. But whatever it is, there's not a credit check or anything. You just do it, and that builds up. And now you've got people who every month they have to pay $500 for this and $600 for that, for things that they probably consumed 6 months ago. The truth is, as everybody knows, and Jerome Powell himself knows, they are in a no-win situation. In my view, they're in a no-win situation. If they keep rates too high higher for longer, they really risk the economy and unemployment, and the threat to the federal government finances, of course. And the problem, I think it's important, sometimes if you put it into a human story term, it's easy to understand. The individual the family that bought a used car, 5 or 6 years ago, and they probably paid, I don't know what used car loan rates are, to be honest with you, but let's say LIBOR plus 5, would that be reasonable?
That probably sounds about right. Yeah.
So 7 years ago, they would have paid 6%. Now that clunker is dead, and the family has to go out and buy a new car. Well, now LIBOR plus 5 is 10%.
Yeah.
So the rate that they are paying has just gone up. The monthly payment has just gone up dramatically. And this is a family that might be living, paycheck to paycheck. So they could just about make the paycheck, the payment on the last car. Now it's suddenly gone up by 60, 70%. The company that borrowed money 5 years ago at LIBOR plus 2, 2.5 plus 2, they were borrowing a good quality, a good credit 4 years ago, 5 years ago, could borrow 4.5%, 5%. Now they're borrowing at 8, 9%. I mean, and that money is going to roll over. So the higher for longer mantra, the longer we go on with interest rates where they are, then the more households, the more corporations who may be good credits or they may be poor credits, but the more households and corporations suddenly come into the new higher interest rate environment. I mean, if a company, let's say a company termed out all their debt 5 years ago, the higher interest rates haven't affected them until their debt matures, and they have to roll it over. Then it suddenly affects them all at once. So, the Fed is in a very difficult position. Jerome Powell, clearly, we know this anecdotally from people who know him, Jerome Powell is concerned about his legacy. He does not want to go down as, everybody says, the other Arthur Burns, which is a little unfair on Arthur Burns, but he doesn't want to go down as the person who, cut interest rates too soon and allowed inflation to blossom. And I suspect that if Jerome Powell keeps interest rates higher a little longer than he should, but manages to bring inflation down, he can retire when it's time for him to step down. Even if the economy is in a little worse shape and unemployment is a little bit higher, he can say, I killed inflation. The truth is, he cannot kill inflation in the way that Volcker did. We forget, when Volcker came in, the Fed funds rate was already double digits. So Arthur Burns wasn't quite so bad. It was there was Miller between the two, but so we already had the Fed funds rate, I think, at 12%, but it was certainly double digits when Volcker came in, and Volcker doubled them, more or less doubled. Powell simply cannot double rates from now. I mean, he got way ahead of inflation, Volcker. We simply can't do that right now because of the debt in the economy.